What's up, guys? It's Mr. Null Explains, and today I'll be teaching you guys 10 things you need to know about stocks. So let's start off with number one. Number one is buy low and sell high. Sounds so simple, right? And yet investing is a rare part of our financial lives where things get cheaper feels like a bad thing. Few consumers are lamenting cheaper prices at the pump amid the collapse in oil prices over the last year and a half. Yet a moderate market fall is treated as a death knell for the bull market. These are facts that are not mutually exclusive. The current bull market will end, and over almost any long-term horizon, stocks have proven to be beneficial investments that generally grind higher. Number two is there is no such thing as a sure thing. Oil prices at $100 a barrel are here for the long haul. Alibaba is a world betting juggernaut that can't be stopped. ESPN is immune to the shifting sands of the cable business, and its ability to mint money for Disney will never be in doubt. Just three examples of storylines once taken as gospel that have been shot full of holes. A word to the wise, the conventional wisdom isn't always wrong, but it equally has terrible times. Some of the stock market best investors over the long term. Warren Buffett. Which long-term games for stocks at large have historically been a safe bet, individual comparisons are inherently riskier. Third thing you need to know is get familiar with filings. While some investors might think they have a sixth sense for finding good companies, the rest of us have to do our homework. There's no better starting point than the regular filings public companies made with the SEC, which are required to detail everything from company finances to potential conflicts and risk factors. The annual 10 through K includes the most informational, ranging from quarterly and annual financial numbers to descriptions of business lines and management commentary on growth opportunities and costs. Regularity filings will also detail any senior management changes, acquisitions, and stock transactions by executives or board members. Number four, think long term. Taxes aren't the only short term trading in a loser's game for more investors. Trying to buy or sell shares based on a quarterly earnings report or an economic data point is a game for automatic trading platforms, not the average Joe. Better opportunities come when a stock or sector is dismissed by the market and languishes despite steady economic results that will produce a long stream of profits. Transportation stocks like airlines and railroads have gone through a log out of favor stretches, only to churn out a considerable gains when economic conditions and industry dynamics align. Number five, dividends are your friend. Share price drops from Apple's share price dropped from $110.38 to $105.26 in 2015. That's an 11% decline, but investors who own the stock all year lost just 3%. Why? Because Apple paid out $2.03 in dividends over the course of the year. Dividend-paying stocks are immune from declines, but they do offer a degree of insulation that others don't. A word of warning, though. Rich dividends that look too good to last often don't. Just ask owners of Kinder Martin, which slashed his quarterly payout by 75% in December. Number six, there is no perfect metric. Professional and amateur investors alike have their favorite measures of growth and value, from price-earnings ratios to dividend yields and profit margins, but there's no single number that divides good stocks from bad ones. A stock that looks cheap at 10 times earning can be to 5 times in a flash, and a flashy tech startup that looks pricey at 3 times sales can easily jump to 6 in a heartbeat. Number 7, a $100 stock isn't expensive and a $5 stock isn't cheap. The price of a single share is not the right number to evaluate when deciding if a stock is good to buy or not. While triple-digit price tags might cost too much for a new investor with limited funds, loading up to $101 stocks isn't necessarily a better strategy. Think of investing like grocery shopping. There is a reason you go to the store with a list instead of just deciding what to buy based on price tags. Number 8, taxes can take a bite off your profits. The FANG stocks, Facebook, Amazon.com, Netflix, and Google, had a great run in 2015 with returns ranging from 34% to 134%. But from tax perspective, any investor who bought last year and eyeing the exits wants them to keep climbing. That's because the 1 year mark is a line of democration for the tax man. Number 9. Know what you need and what you're paying for. The evolving brokerage industry is a beehive of competition to offer the latest and greatest trading options, but for most investors, the basic essentials can be found anywhere. Make sure you know the type of buy or sell order you're entering. A market order, for instance, will be executed as soon as possible, whatever the prevailing market price. A limit order, by contrast, will only complete the transaction within price parameters you've established. Number 10, and the final one. Take market news with a whole shaker of salt. The first trading day of 2016 had no shortage of headlines, from plummeting Chinese stock market to GM's investing in Uber rival Lyft, and the severing of relations between Saudi Arabia and Iran. But is that any reason for U.S. stocks to plunge more than 2.5%, as they did before bouncing off their lows? As an investor, the news flow driving day-to-day variations in the market should be taken as interesting reading rather than a reason to make or change strategy. Well, thank you for listening, and hopefully you learned a lot about stocks. Mr. Nall explains, and that's it for today. Alright, see you next video.